Welcome to the Ronald Blue Trust Wisdom for Wealth for Life video podcast. As these unprecedented times persist, we want to provide you with encouragement and perspectives from different leaders and professionals across the company. Today's video features Julie Swanger, a Ronald Blue Trust Senior Investment Strategist, and David Lebovitz, Executive Director and Global Market Strategist for J.P. Morgan Asset Management.
Welcome to today's investment podcast. I am Julie Swanger, and I'm joined today by David Lebovitz, an Executive Director on the Global Market Insights team at J.P. Morgan Asset Management. He joined the firm in 2010 with a political science and philosophy degree from Williams College and an MBA from Columbia University and London Business School. David, thanks for coming on the podcast today. I look forward to spending some time talking to you about the upcoming U.S. election.
Yeah, thank you so much for having me. I'm looking forward to our conversation as well.
Likewise. So let me kick it off, just jumping right in about the elections. You know, they're 3 months away, or less than 3 months away. What does U.S. economic recovery from the pandemic look like to you under a Trump or a Biden administration, considering party control in Congress may also change?
Yep, it's a great question. And I think it's important to differentiate between the outlook here over the short run and then the outlook over the long run. I think at the end of the day, you know, regardless of who takes the White House and regardless of what happens with the composition of Congress, you are going to see continued support for the economy. You know, we've seen things begin to come back here over the past couple of months. But we are by no means out of the woods or close to being out of the woods quite yet. I think the unemployment rate at 10.2% is arguably the best indicator of how much more road there is to travel before we are back to where we were at the beginning of this year. So when we think about the short term, again, regardless of who takes control in Washington, we do think that fiscal supports will very much remain in place. Longer term, however, there are policy questions, and the outcome of the election will have an impact on the shape of the recovery a couple of years down the road. And just a handful of things, you know, that we've been focused on. Obviously, the Biden administration, or the Biden party, has said that they would like to increase both individual and corporate income tax rates. That would be a bit of a headwind to the recovery, depending on the timing with which it does occur. You've also seen a bit of a push on their part to increase regulation, return to more Obama-era healthcare policies. And I'm not necessarily sure that would move the needle all that much with respect to the broad direction of travel, but obviously would lead to an increase in government spending. On the Trump side of the equation, you know, obviously a big proponent of deregulation, likely leave taxes where they are. But I think that the one key issue that frankly is going to be with us, regardless of who takes control of Washington in November, is the China issue. And both parties have said that they are interested in trying to continue leveling the playing field between the U.S. and China. And obviously the way in which that is done will have implications for the recovery. As we saw last year, the business community does not react terribly well to tariffs being put on traded goods, and so potentially a more diplomatic approach on the part of a Biden administration could end up helping to boost overall economic activity at some point down the road.
So let's talk specifically about China. And with the rise of tensions between the U.S. and China, how do you see the relationship between the two countries evolving under each administration following the November elections?
So again, you know, I think that it's going to be an issue which is front and center regardless of the outcome of the election. I think that the biggest difference will be in the way that the situation is handled. And, you know, what we saw in 2019 is that the current administration can have fairly sharp elbows. They like the idea of putting tariffs on Chinese imports, and they view that as a way of trying to get China to play more nicely in the sandbox. I think that under a Biden administration, you would likely see a slightly more textbook approach to international relations, probably a little bit more predictable, a little bit more about sitting down at the table and having the conversation, as opposed to the tit for tat with tariffs that we saw from both sides, both the U.S. and China, for the better part of 2019. But again, you know, the end goal here, the end result is fairly similar, regardless of which party finds themselves in Washington. And so we do think that the direction of travel will be the same, but the actual road we take may be somewhat different. We do get a lot of questions around the amount of U.S. debt that China holds, and people oftentimes say, well, if we really made the Chinese angry, couldn't they just end up selling all of their treasuries? And the answer is that yes, they could, but they would actually be doing themselves a disservice by doing so. They hold so much U.S. debt that they could actually move the price of the debt if they were to attempt to liquidate all of their holdings. And so when we think about the U.S. and China here, it's very much a symbiotic relationship. We buy their stuff and they buy our treasuries. And I think that both parties have an interest in continuing to try to normalize the relationship going forward. But importantly, both parties have a vested interest in not seeing things completely fall apart. And I think that going forward will be important to keep in mind, regardless of who finds themselves in the White House at the beginning of next year.
Right, that makes sense. So going back to the pandemic and talking about trade, the pandemic has highlighted some vulnerability to U.S. supply chains due to globalization. So to what extent will there be a political effort to onshore supply chains in the U.S. after the November elections? And what do you think the effects will be on future economic growth?
So the supply chain conversation is an interesting one and something that came up quite a bit over the course of the past 12 months. You saw a lot of companies in response to the escalation in U.S.-China trade tensions last year begin to reorient supply chains, and whether that was just moving them out of China into other parts of Southeast Asia, or in some cases moving them back towards North America as the cost advantage that Chinese labor once had has gradually eroded over time. This was very much a process that was already in motion in the run-up to the pandemic, and I do think that when we get to the other side, you will likely see that overall shifting of supply chains continue. Now, specifically on your question of re-onshoring manufacturing production, it certainly could happen. When we look at the most successful developed market manufacturing economies, places like Sweden and Germany, the one thing that we have found is that as they do more manufacturing in their own backyard, that manufacturing also becomes increasingly automated as well. And so I think you could also see a push, if manufacturing were to come back to the US, to arguably try to automate it as much as possible. And really that would create jobs that are tied to the programming and the structuring of those facilities as opposed to traditional manufacturing employment. And the reason that we don't necessarily think that it would result in the widespread creation of manufacturing jobs is because that would end up putting pretty significant downward pressure on corporate profit margins and corporate profitability more broadly. And so, when corporate America stops making money, they oftentimes try to figure out something that they can do to adjust the course that their profitability is on. And I think that automation, based on what we've seen around the world, is a clear first step to trying to get that situation under control if we were to bring manufacturing back to the US. And so maybe it happens to a certain extent, but I think the broad-based re-onshoring of manufacturing is going to be a challenge. And again, if it does happen with any sort of significant scale, I think it's going to be accompanied by a fairly significant amount of automation as well.
That makes sense. Thanks for that. So how much does future economic growth and future equity returns depend upon the outcome of 2020 elections in the near term? So fast forwarding and, 10 years from now, when we look in the rearview mirror at the 2020 elections, what do you think the charts will look like?
Yeah, it's the question that we get more than anything these days. What I would say, just at a very high level, before we dive into the economic implications, is at the end of the day, I think that this election is going to be close. And I think that the most likely outcome, I really don't have a strong view on who's going to end up in the White House. And I think that the polls are going to show the race getting closer here over the next couple of weeks. I arguably think the most important races are going to be the ones on the congressional side of the equation, because if we were to see a Democratic sweep and a blue wave take hold of Washington, that would obviously make it easier for that party to push through a handful of their policies. And that's really the key thing. We're big believers that politics are fun to talk about with your friends and family, but it's policy that really matters over longer periods of time. And so, when we think about the potential for policy to shift here, that is really dependent on one party having full control down in Washington, D.C. And so, again, our base case is that Congress does remain divided, and the White House, I think the race is going to be close. I would assign about a 30% probability to the blue wave scenario, where Democrats take control across the board. And, in terms of what this means for the economy over longer periods of time and the way that we think about the market, one thing that I'll say about politics in the United States is that if you don't like the weather, just wait, because eventually it will change. And again, absent a sweep across the board, I think it's going to be very difficult to see any sort of significant policy shifts in the short to medium term. And longer term, when we think about the structure of government in Washington, since 1948, about 62% of the time, we've had a divided government in DC. And that's really the ideal environment for the stock market, because what it means is that you can get stuff done, but both parties need to be buying in. You're not just getting these blind pushes through the system and the subsequent change in policy. And so when we think about the direction of travel over the longer term, it's not that politics don't matter, but it's that a very unique and specific setup for politics is really what drives the most significant policy change over time. And again, that is a setup which is relatively difficult to achieve. And so we think that the most important thing here is that investors recognize in the short run, politics may well cause volatility, but over longer periods of time, it's policy that really matters. And over the long run, despite the ebb and flow of Washington, D.C., the stock market has trended higher, and we're confident that regardless of the outcome of this election in November, the same will be true here going forward.
Very good. That's reassuring. I appreciate that. Well, David, thanks for spending time talking with me today. I enjoyed hearing your thoughts and analysis, and I look forward to catching up with you again sometime soon.
Absolutely. It was my pleasure. Thanks for having me.
Thank you.